Hello everyone, and thank you for joining us for today's presentation as part of the Industry Insight webinar series. The topic this time is 10 do's and don'ts of legal trust accounting. Speaking today will be Erica Bursler of Cosmolex. Erica is the Director of Strategic Communications at Cosmolex, developers of an all-in-one cloud-based legal practice management, billing, and trust accounting system specifically designed for solo and small law firms. Erica's degree is in business administration, and she has over 6 years of experience in the legal software industry, catering to the specialized technology needs of small to mid-sized law firms. Erica has given numerous presentations across the country on legal technologies such as law practice technology management, cloud computing, and legal billing and trust accounting compliance. The presentation today will be followed by a Q&A. Please enter your questions into the question box on the webinar panel on the right side of your screen. All questions will be addressed at the end of the presentation. We're recording this webinar and we'll be sending a video and a follow-up email in a few days. We'll also post a video on our blog at www.lawtechnologytoday.org. Thank you all for joining us, and we'll now begin the webinar.
Very good, thank you so much. So as mentioned, we're going to be talking about trust accounting today. So our agenda for today's presentation, first, kind of break down the components of legal accounting, which of course brings in trust accounting, but it's good to have a big picture. What specifically are trust funds? The do's and don'ts of legal trust accounting, and how can technology help? Very often when dealing with a trust account, the reason why it can be so complicated or daunting or intimidating is due to the types of tools that you're using. So we'll talk a little bit about how to really help you through all of the different processes for trust accounting. All right, so the components of legal accounting. So there's 3 components. First is business accounting. This is really what every business needs to worry about. This is really the back office accounting, payroll, office supplies, really any expenses, any income, profit and loss, balance sheet, pretty standard for businesses across the board. However, there is a legal specific aspect of that deals with matter costs. So making sure that those costs that you're cutting out of your pocket for your client are effectively passed through to them and reimbursed. That takes us to the second part, which is matter cost and income accounting. So this both has to do with posting those costs correctly, the ones that need to be reimbursed, and once they're reimbursed, having the income posted correctly. Also for invoices, income posting is unique for legal accounting, so making sure that everything gets allocated properly and in the right order. And the third piece, which is what we're going to be focusing on today, is fee advances and retainer accounting. So this is when you're dealing with client funds that might be held on account for legal fees or expenses, and this can include retainers or also escrow funds, even personal injury settlements, and the disbursement of those funds as well. So anything related to client funds or retainers falls into that category, which of course is really where trust comes into play. So let's talk about what trust funds are. So they are advances or funds received into the trust account. Specifically, it is revenue not yet earned, which is a very important point from an accounting perspective as well, because at the end of the day, you're running a business also. You want to make sure you're recording those trust funds properly, and it should be a liability to the firm, which of course will be a balance sheet item. It is not income until it is actually earned. And third point is these are funds for the benefit of the client. It can be escrow, can be probate, can be judgments or settlements, can also be retainers or advances as well. So let's start with our do's and don'ts. So the first item is you do want to understand which funds go where. Now, in some states, you can receive payments directly into your operating account. You can receive check or cash or retainers, but in other states, everything has to go through the trust account. So it does very much depend on your state or your jurisdiction. So of course, it's important to know the jurisdiction that you're in, the compliance mandates that are in place. At the end of the day, you are responsible for knowing that, and you can't compare it to a colleague next to you who might be practicing in a different state. You need to be aware of what's important for your location, and also note that special rules could relate to your area of practice. Certain types of funds might have to go through the trust account no matter what. For instance, escrow or settlement funds. It's pretty much a known fact that when you're working in those, no matter what state you're in, those funds have to go through the trust account. So that's just an example. Some ways to help with that is to be part of groups related to your practice area, either with your bar association or in your community, so that you can be more aware of those specific requirements. Now, of course, we're not going to be breaking down the rules for each and every jurisdiction, but we can clarify in general what does or does not belong in a trust account. All right, so with the trust account, you can have, and some of these I've already covered, you can have settlement funds, of course. These are basically going to be dispersed to various parties towards the end of the settlement. Any unearned income, which could be retainers or those fee and cost advances, judgment funds, or third-party funds. Anywhere you're willing to be the fiduciary on those funds, you can go ahead and house that in the trust account. Now, this all seems very straightforward. However, there's also funds that should not be in the trust account, which is important to note as well. There should not be any personal funds in the trust account. Really, anything not related to your clients should not belong in trust. Now, in some cases, in some states, you're allowed to have a nominal amount of personal funds to cover things like service charges or bank charges. We'll talk a little bit about how bank charges and whatnot should be handled, but in some states, they allow you to have a couple $100s. You need to know exactly what that amount is so you don't exceed it. But it's best to not really involve your personal funds in the trust account, because you also need to keep track of that. You would basically be like a client and need to know what part of that trust balance is your own personal funds at any given point in time. Earned income, anything that you have earned should be withdrawn from the trust account. I do know of some law firms, they go ahead and bill a client, they earn that money, and then it kind of sits in trust. They decide, oh, at the end of the month I'll move it, or I'll wait to move it, and really that should be moved right away, because you don't want to be under the false perception that that money is available. It's not. It's officially earned. So you should move that over into your operating account right away. Payroll, that's an example of a business expense. Nothing related to the office, operations, any general office expenses, none of that should come out of trust ever. It just should not be commingled with the trust account. And we'll talk about that a little bit. That's one of the don'ts as well. And wherever you're not the fiduciary trustee, it is, if somebody says, hey, I have this money, can you hold it in a trust account? There's a lot of responsibility that comes with that. You're responsible for those funds, making sure they're handled properly. And if you don't want to sign up for that responsibility, then do not take those funds into your trust account. That's very important to note. And very often in many of these cases, people think, oh, well, I'm not managing the funds, I'm just holding it in my trust account. Well, if it's your trust account, you're responsible for those funds. So always keep that point in mind. I'm sure most of you want to have as few funds in trust as possible, which is usually the case, but in case those opportunities arise, you don't want to take them. All right, so another point is you want to have a distinct separation between operating and trust balances. You might be holding client funds in operating account, trust account, or both, depending on your jurisdiction. So you want to make sure that nothing is jumbled. Everything is clean, separate, easily visible. There needs to be a very strict distinction between the two types of funds. Now, most billing systems that you work with don't include accounting functionality, so they won't be able to adequately differentiate between those types of funds, specifically when you're dealing with retainer deposits as well. So you want to look for, what really helps is legal specific solutions, because they have a concept of a retainer, concept of a matter, concept of fund balances, so you know that you'll be able to keep that neat, clean, organized, and compliant as well. Now, an example, I will be using Cosmlex kind of as a tool to give you some visual as to what we're referring to with some of these trust practices. So let's talk about the retainer side of things. So I'm going to jump into my program here. And this is a listing of all of my cases. I'm on my matter page. So I have for any particular case, I can see billing balances, but also trust balances. All right. So I know at any given point in time what I have in that client's account for trust. Let's say you're in a jurisdiction where you can accept operating retainers. We have this column that has operating. Now, you should be able to divide it completely, be able to see very easily what is operating and what is trust. In your records, as well as, of course, in the actual bank itself, they're two separate bank accounts, but there needs to be a clear distinction, even though they both may be retainers, as to what type of account those may be in. Another thing is within any particular matter, not only do you have the balance visible, you want to be able to see it as you're doing any particular type of work. So if I'm in a case and I'm going to go, add some time, do some invoicing, add a transaction, these balances here are always visible. So you always are aware what is in the trust account, and if you happen to have operating retainers, what's there. So those client funds have to always be visible to you. I do know many attorneys struggle with using general accounting tools because they're not built with this matter-centric type of concept, and it may be a little bit more difficult to find this information. So you want to make sure it's easy to locate the balance that you have in trust at any given point in time, and we'll talk more about the activities related to that balance and making sure that everything is matter-centric. Our next point is you do want to track individual ledgers. So whenever you're managing client funds, every single penny needs to be accounted for and attached to the appropriate client and matter. And that is regardless of what type of bank account per se, it's the fact that it is client funds. So whenever you're dealing with client funds, you need to properly account for them on the individual case itself, on the ledger, and that can basically make sure that you're remaining compliant, especially in terms of ethics guidelines. You want to always be aware, as I mentioned, that individual balance. Now, it's not just about the balance, of course, it's about the transactions within as well. A full ledger for a client is the money in, money out, what took place, what was the activity, and then, of course, overall, what's the balance also. Another key point, and this comes up on a lot of reports, is a running balance. You should always be aware at any given point in time what the balance was let's say you're reporting on the past year, what the balance was at any given point in time after particular transactions so that you know you haven't overdrafted on that ledger. So let's go into the ledger of a particular matter. So I'm here in Catherine Dean's estate case, and I actually can go within the banking area and I can see her full ledger. So this is for her trust account. I could see the checks and deposits, and these all add up to this balance right up here. So I am well aware of what has come in, what has gone out, the different checks that I have cut. I even have some checks that I need to print here. And of course, you can generate this as a report, like a ledger transaction report. We have a lot of reports that support that. But in general, you need to have what's kind of like a mini bank statement for each one of your matters. So that way you know the activity that happened. Now, this is all part of one big bank account, but you need to know the activity that happened for this particular matter. Now, another point to bring up is when you're invoicing your clients, a lot of times what can be a struggle is if your trust accounting is handled someplace other than your billing, which is quite often, you need to make sure your client is always aware of what they have in trust. They always should have that number available to them. So when you have an invoice, for instance, I should be able to see that at the bottom of my invoice. So let me go ahead and pull this invoice up for you to see. And zoom in a bit. All right, I have a cover page, but then I'm going to scroll down to the actual invoice. I have some items here, time and expense. The important part's the bottom though. Here I have my summary. My invoice amount, it was paid actually from retainer. And I have actually a replenishment amount, which I'll talk about a little later, but here's my retainer balance. So my client will know, and I don't have to enter that, I don't have to tell the system. The client will know that this is exactly what's in the trust account for them going forward. And that's important. It's a requirement in many states that your client has to be aware of what they have in trust at all times. So make sure that this information is reflected on your billing so that way they're always informed. Okay, our next point is don't commingle funds. So that is probably one of the key, I would say, areas that you need to be aware of when referring to your trust account in terms of compliance. It's definitely when it comes to commingling. Now, this all comes down to being aware of your matter balance, making sure that the type of transactions and anything that you do with the trust account relates back to that specific matter, and then following those rules, you should not have any commingling. But let me tell you the types of commingling that I'm referring to. You could have, for instance, personal funds in the trust account. I mentioned that before. Sometimes you're allowed that little bit of buffer, maybe a couple $100s, but other than that, there shouldn't be any personal funds in the trust account. You want to be able to easily know, and even if you do, let's say you have that $100 buffer in the trust account, and let's say you have 10 other clients' money in the trust account, then you should have 11 ledgers, 10 for your clients, 1 for you and your personal funds. So that way you know that maybe $125 is your money. But again, you should only have those personal funds in there if it is allowed in your jurisdiction. The second is operating and trust funds are not tracked separately. That's a big problem. There are some firms that can get a little bit confused as to what's theirs, what's their clients. Maybe they're not moving their earned funds over in a decent time frame. So when they look at that trust account, they're like, well, my trust account has this balance, but I know some of that is my money. That should never be the case. You should always be 100% sure of what money is your client's, and your money should be in the operating account. Another example of commingling is between matters, and that usually happens when you're allowed to overdraft. Overdrafting is pretty much, let's say you have $2,000 for a client in trust, and you cut a check for $3,000 for that person. You're taking $1,000 from another client. That is commingling. So that itself is not allowed. So of course, the next point would be around overdrafts. That's probably the biggest don't when it comes to trust accounting. Do not overdraft on your ledgers. Now, the reason why this is so important is, of course, these are your client's funds. They're not yet yours. They're not yet earned. So you need to make sure that you're handling them properly. When you overdraft, as I mentioned, you're taking funds from another client, and that essentially would have to be explained. Very often when that happens, the firm would just say, oh, let me throw some money in there to cover that and figure it out later. You don't want to be in that situation. You don't want to be slapping a Band-Aid on it and hoping you don't get audited and hoping you don't have to explain it. You want to be using tools that prevent this type of activity. Really, it needs to be a trust-specific or legal-specific tool. That's the only way you're going to find this. General accounting software has no concept, as I said, of a matter, of trust accounting, of ledger balances, so you can do whatever it is that you want. I actually spoke with somebody earlier today who is using QuickBooks, and she's terrified because she has 3 ledgers that are all negative. And she's like, how come QuickBooks let me do this? And I say, because it's not built for trust accounting. So if you use those types of tools, not to say that you can't, but you need to be very, very aware of the types of transactions that you're entering, because the system's not going to stop you from overdrafting on those ledgers. If you're looking for a tool that will stop you and basically prevent it altogether, then you need to look in the direction of something legal specific. So let me give you an example of how that's done in Cosmolex. Since we are legal specific, we follow just your general trust guidelines. So if I find a matter, actually the one I was working on before, I have just over $1,600 in trust. Let's say I'm not paying attention. You know, I'm not looking at my balance. I know that I have a $2,000 check that I need to cut, and I'm going to go ahead and cut it. So here, I'll say I have $2,000. I'm going to cut it as a check to third party, and then save. So the system knows right away that this can't be done. It lets me know that it can't be done, but also tells me why and by how much. So right away I could say, oh, because usually this is just by mistake. It's usually just negligence. It's not done on purpose. But I can say, oh, wow, I didn't realize I didn't have that money. Let me contact my client before I do this and make sure I get that, let's say $350 to cover that expense. And it just avoids the whole situation altogether, and you're not having to explain about an overdraft, why it took place, and possibly have an issue. That's probably one of the favorite functions in terms of trust accounting in our software, because a lot of times you're multitasking, you're doing different things, there can be distractions, and it can happen easily by mistake, easily. However, if you get audited, and the auditor says, looking at your running balance and saying, hey, you've gone negative at least once on this matter, why is that? And having to explain yourself, saying, oh, I didn't realize the balance was that amount, is not sufficient. So you need to be able to just avoid it altogether and not put yourself in that position. Do maintain evergreen retainers. So even if your practice is 100% retainer based, your retainers eventually deplete. Unless you're receiving your fee 100% up front, there's nothing additional. But if you're actively working on that case, eventually that retainer is going to deplete. Then you're going to be left with no funds. Your work may either come to a stop, or you might be essentially working for free until that retainer gets replenished. So instead of risking that type of situation, you want to have a process in place that keeps track of your retainers and kind of a threshold where, you know what, I want to seek replenishment at this particular point in time. And there are many tools that can assist you with, you know, types of reminders, notifications, things that involve your billing as well. And I'll give you a couple examples of that. So Evergreen Retainers will ensure that you're not having to chase your clients for more money once it's already depleted, and that you can continue your work and everything's pretty seamless. So let me show you some retainer tools which are very helpful. When I set up a matter, so let me actually look at this matter. I think I have one set up, but let's see. So for this matter, we have the ability to set a minimum retainer balance required. I happen to have it as $2,500 for Catherine. All right. Once it gets to $2,500, I want to go ahead and let her know I need replenishment. So for each matter, this is a setting per matter because it can vary. You might have one case where you're going to kind of burn through that retainer much quicker than a different case. So here I have that set, which is good. In terms of replenishment, I have a couple options. One, I have this low retainer reminder where the system's basically going to let me know everyone who's low on their retainer. I have 18 matters in which I set a minimum and they are below that minimum. So I have here what's required, what they actually have, and therefore what needs to be replenished. So I can come here, we have an email notification tool if I want to use that. I can access I can send email and access a template that's here that you can customize, pretty much letting them know, hey, this is what we agreed upon, this is what you currently have, I need this amount of replenishment. So this is a batch activity. You can do a whole bunch at once. It's separate from your invoicing, definitely very convenient. But if you want to involve it in your billing, let's say you want them to see that when they see their invoice. And I showed that a little bit before. Let's see if you spotted that, but I'll be happy to show it again. When you have a replenishment, you can also use, in our system, we have a specified template, which includes replenishment amounts. That means it's going to show the invoice amount as well as if I'm low on retainer for this person, what is the replenishment? And this I showed before. Let me show you one more time. All right, on the same invoice, you'll see, and this is Catherine. Remember, she has a $2,500 minimum. So at the very bottom here, it's saying I need $842.50. Additional required retainer amount, $842.50. It added it to the bill. So I paid her invoice amount from retainer, but I have an additional $842.50. So she's basically getting a bill for $842.50 to replenish that retainer. It's completely automated. All you have to do is have that template selected, have a minimum set for that person, and when they go below that minimum, it's automatically going to populate on the invoice. So it's definitely more automated, and it just depends on whether or not you want that involved with your invoices that you're sending your clients. But any tool that you're using, you want to make sure that you have ways of tracking the retainers, setting that minimum type of threshold, so that way you can seek replenishment before it's completely gone. Don't assume all merchant providers know how to handle retainers. This is referring to credit card processing. When dealing, and this I've actually learned over the past couple of years, when dealing with trust retainers specifically, let's talk just about the trust account. When dealing with trust deposits, not all merchant providers know how to handle that. What I mean by that is let me show you a couple examples. One, does the merchant provider support operating and trust accounts? Both type of bank accounts, they may not. So you want to ensure, because credit cards are not just for invoices. You can receive credit card payments for your trust account as well. The second point is, how are the processing fees handled? Every merchant provider has transactional processing fees. That's part of the business. So they're going to charge an X percentage on each transaction. Now you need to be aware of how those fees are being charged to you. Typically, a monthly deduction is made from your account. It's usually done one lump sum at the end of the month. However, some merchant providers do not even think about compliance when dealing with trust funds, and they deduct those fees from the trust account, which, as you can imagine, would overdraft a few ledgers and results in the commingling of funds. So that can not only cause you a problem with your client funds, but reconciling is going to be really difficult, because if you have a $5,000 retainer from your client and they deposit as $4,999, it's not going to match what they're supposed to have, and that client's technically shorted that money. So you want to make sure that you're using a merchant who knows how to work with trust accounts and only deducts the fees from a connected operating account. They should actually come from your business account directly and never come directly out of the trust account. So if you're handling, two sides to this. If you're working with a merchant provider right now, make sure they handle trust accounts properly. We personally integrate with LawPay. That's kind of their forte. That's where they specialize. They handle trust account fees and whatnot the right way. If you are considering looking for a merchant, keep that in mind as well. And the last piece is, does that service integrate with your billing program? Now, credit card payments are, of course, a convenience to your client, but you also want to streamline your back end when it comes to your processing. That comes down to entering the transaction, updating the invoice balances, entering the income and reimbursed expenses for your accounting. There is back end entries that need to be made. But if your provider integrates with your billing software, and I know LawPay integrates with a lot of different tools, that means those entries can be automatically made in your billing system. That payment is entered, that invoice is updated, and that's one less step you need to do. So a couple things to think about if you're considering evaluating your current provider or maybe looking to start accepting credit cards. I shouldn't really have to explain this, but I always feel the need to go into a little bit with reconciling because it is so essential for the trust account. You need to reconcile at least monthly. That is how you catch any mistakes that take place. It can be keying errors, it can be an internal mistake, or bank's mistakes. I have heard of double deposits, double withdrawals, and they don't know until you say, hey, wait a minute, what did you do here? And they say, oh, didn't realize it. They don't understand that with a trust account, it's not like my checking account. It's not like, oh, no big deal, put it back when you need it. No, it needs to be handled sooner rather than later, because like it's your client's funds. You want to make sure those are handled properly. Having one program to manage your retainers, which is a billing activity, and another for your reconciliation, which is more of an accounting activity, that having two programs separate can make it very complicated. Having them together will ensure that your balances match, because if you have two separate programs, you can have trust balances in your billing program and trust balances in your accounting program. How do you know if they match? How do you make sure that everything's going right between the two programs? So you will need to reconcile regularly, but definitely having them in one program is helpful. In addition to monthly reconciliation, you want to look into things like bank feeds, which can feed in that information every single month. So that way, every single day, so that way you can check it daily. I can see each day what has cleared my trust account and address those issues each day, as opposed to at the end of the month when I'm going to do my reconciliation. But the minimum is every month. If you could do it more often than that, then you can do that also. So a few options. Technology obviously helps a lot with that, to be able to reconcile. Just to give you an example of kind of what reconciliation even looks like, in case that's something that you may not be handling yourself. But if I go in a trust bank, reconciliation, I have my monthly statements, and the system basically lays out all of my transactions for that month, my deposits, my payments. I can compare this to my statement. I can even import my bank statement to compare it automatically, or like I said, bank feed. So this is the area you find out if there's mistakes, issues, comparing the two. Your difference needs to be 0 in order to close the month. Very important. There's one thing you do for your trust account, make sure you reconcile at least monthly. And the final piece is maintaining proper reports. You reconcile, everything matches, that's great, but you need to have the reports for that as well. You need to be able to show your trust ledger activity, what money in, money out, running balance to prove that you don't have an overdraft. You also need to have reconciliation reports, specifically a three-way reconciliation report, which is a trust-specific report, and it compares your bank balance, your book balance, and all of your ledgers. And I do want to show what that report looks like for those of you who may be unfamiliar. And this is trust specific, so a general accounting software is not going to have it. Legal specific accounting programs should. And let me just give you a sense of that. So here I have my report. Let me zoom it in a little bit. You can see my month is reconciled. This is my particular bank. I have my book balance, my bank balance. I have some uncleared items, which is fine. And then all of my ledgers, all of my client ledgers add up to that same number. That's the three-way check. That's what auditors look for. If you're handling a trust account, obviously, which you all are, depending on how active it is, you want to be able to produce this type of report to make sure everything is matching up properly. My final point is a lot of these do's and don'ts do center around having the billing and accounting separate. They communicate quite a lot with each other. Both billing and accounting deal with trust accounting. So that kind of bridges these two gaps in general, this one gap between the two. But you want to make sure that everything is matching. As I mentioned, you might have trust retainers for your billing, trust retainers for your trust account in accounting, and you want to make sure everything matches. And it's very easy to kind of not only spend more time with double data entry, but increase the number of mistakes by having that separated apart. So definitely having all of that together is a big help to making sure your numbers are accurate. You can trust the information, knowing that you've reconciled there, everything's correct. So something to think about, and it's definitely possible. I mean, we do have that with Cosmolex. That's one of the examples of all-in-one, where you have your billing, you have your practice management, but also the full legal specific business accounting and trust accounting. So hopefully with going through all of the do's and don'ts that we've discussed today, you can make sure that you're handling your trust accounting in full compliance.